Why does Warren Buffett, one of the most respected investors in the world, say you should never invest in Bitcoin? Despite the buzz around cryptocurrencies, Buffett remains skeptical. He points out that Bitcoin lacks tangible value, is highly speculative, and doesn't generate any cash flow like traditional investments. With its extreme volatility and dependence on future buyers, Bitcoin is seen by Buffett as a risky venture. His insights provide a cautionary perspective that can help investors navigate the complex world of cryptocurrencies. Now let's explore Buffett's reasons in detail and understand why he advises caution when it comes to Bitcoin. Lack of tangible value. Warren Buffett emphasizes that Bitcoin doesn't produce anything tangible. Unlike farmland that yields crops or apartment houses that generate rent, Bitcoin lacks inherent value. It's essentially a digital asset without any underlying physical or productive use. For Buffett, a sound investment should have the ability to generate value over time through its productive capabilities. Farmland, for instance, produces food, contributing to society's needs, while rental properties provide housing and generate consistent cash flow. Bitcoin, however, does none of these. It's a digital construct whose worth is based solely on what others are willing to pay for it. This lack of tangible value makes Bitcoin a speculative asset rather than a solid investment. Buffett's investment philosophy revolves around purchasing assets that have real-world utility and contribute to economic productivity. The absence of these qualities in Bitcoin makes it an unattractive option for long-term investment. This perspective underscores the importance of understanding the intrinsic value of an asset, which Bitcoin fundamentally lacks. For investors seeking stable and productive investments, Buffett's advice serves as a reminder to focus on assets that generate tangible value and contribute to sustainable wealth growth. Speculative nature. Buffett views Bitcoin as extremely speculative. Its value remains uncertain, with no guarantee it will appreciate over time. Investing in something speculative can be risky, especially when the future of cryptocurrencies is still unclear. Unlike traditional investments like stocks or real estate, Bitcoin's worth hinges purely on market sentiment and the hope that others will buy it at a higher price later. This speculative nature means that Bitcoin's price can fluctuate wildly, influenced by factors like regulatory news, market trends, and public perception. For Buffett, this lack of stability and predictability makes Bitcoin a gamble rather than a solid investment. He prefers investments that offer reliable returns through intrinsic value and productive use. With Bitcoin, there's no income generation, dividends, or tangible output, only the potential for price appreciation driven by market hype. This uncertainty and reliance on market speculation make Bitcoin a high-risk investment. Buffett's cautious approach highlights the dangers of putting money into assets that lack clear value and dependable growth. For those looking to build long-term wealth, he suggests focusing on investments with proven track records and inherent value, steering clear of the unpredictable nature of speculative assets like Bitcoin. No cash flow or dividends. Traditional investments like stocks provide dividends or cash flow, offering regular income to investors. Bitcoin, on the other hand, doesn't generate any income. When you invest in Bitcoin, you're essentially hoping that someone else will pay more for it in the future, which Buffett considers a risky proposition. Unlike a stock that pays dividends based on a company's profits or real estate that generates rental income, Bitcoin relies solely on price appreciation. This means your return on investment is dependent on market speculation rather than any inherent value or income generation. Buffett's investment philosophy focuses on assets that can produce reliable cash flow, ensuring steady returns over time. Bitcoin's inability to generate cash flow or dividends makes it less attractive for long-term investors who seek consistent and predictable income. This speculative nature of relying on future buyers to drive up the price adds a layer of uncertainty and risk. For Buffett, investing in assets that don't produce anything tangible or provide regular income goes against the principles of sound investing. He advocates for investments that contribute to wealth growth through their intrinsic value and ability to generate ongoing income. Lack of intrinsic utility. Unlike stocks or real estate, Bitcoin doesn't serve a practical purpose beyond being a store of value or a speculative investment. Warren Buffett believes that investments should have intrinsic utility or contribute to society in some meaningful way. For example, stocks represent ownership in companies that produce goods or services, driving economic activity and providing jobs. Real estate offers housing or commercial space, meeting essential human needs. These types of investments have inherent value due to their utility and the tangible benefits they provide. Bitcoin, however, lacks this intrinsic utility. It doesn't produce anything, create jobs, or contribute to economic productivity. Its value is derived solely from the belief that others will find it valuable, which can be a precarious foundation for investment. Buffett's approach to investing focuses on assets that have clear, practical uses and can generate value over time through their contributions to society. This perspective ensures that investments are not only profitable, but also sustainable and grounded in real-world utility. By prioritizing intrinsic utility, investors can align their portfolios with assets that have lasting value and real-world impact, avoiding the speculative nature and inherent risks of Bitcoin. Volatility and uncertainty. Bitcoin's price volatility is well documented, with dramatic swings that can happen within hours or even minutes. Warren Buffett advises against investing in assets with unpredictable price movements, especially when there's no clear fundamental basis for their value. Unlike traditional investments such as stocks or bonds, where prices are influenced by company performance or economic indicators, Bitcoin's value is largely driven by market sentiment and speculation. This high level of uncertainty makes it difficult to predict future price trends, increasing the risk for investors. For instance, a sudden regulatory change or a major market sell-off can cause Bitcoin's price to plummet unexpectedly. Buffett's investment philosophy favors stability and predictability, focusing on assets that offer consistent growth and are backed by tangible value. He argues that the inherent volatility of Bitcoin makes it a speculative bet rather than a reliable investment. By steering clear of such unpredictable assets, investors can avoid the stress and potential losses associated with market volatility. Instead, Buffett recommends focusing on investments that have a solid foundation and proven track record, ensuring a more stable and secure financial future. This approach underscores the importance of minimizing risk and seeking out assets with dependable value. No productive asset. Buffett reiterates that Bitcoin doesn't produce anything. It lacks the ability to generate income, dividends, or cash flow, which are crucial elements for long-term wealth building. As an investor, you want assets that contribute to your wealth over time through their productivity. Traditional investments, like stocks, represent shares in companies that create products, offer services, and generate profits. Real estate generates rental income and appreciates in value as properties are developed and maintained. These investments actively contribute to economic activity and provide ongoing returns. Bitcoin, however, does none of these things. Its value is based purely on speculation and the hope that someone else will pay more for it in the future. This lack of productive capability makes Bitcoin a poor choice for investors who seek to grow their wealth steadily and reliably. Buffett's investment philosophy emphasizes the importance of owning assets that have intrinsic value and can generate consistent income over time. By focusing on productive assets, investors can build a more stable and profitable portfolio, reducing reliance on speculative gains. This approach aligns with the fundamental principles of sound investing, prioritizing tangible value and ongoing financial growth. Dependency on future buyers. Investing in Bitcoin relies on the hope that someone else will pay more for it later. Warren Buffett points out that this dependence on future buyers can be risky, especially if the market sentiment changes. Unlike traditional investments that generate returns through dividends, interest, or rental income, Bitcoin's value is purely speculative. This means your potential profit is entirely dependent on finding a buyer willing to purchase it at a higher price. If public perception shifts or demand decreases, you could be left with an asset that has significantly depreciated in value. Buffett's investment strategy focuses on acquiring assets with intrinsic value and reliable income streams, reducing the risk associated with market speculation. He believes that relying on future buyers to realize gains is a precarious position, as it lacks the stability and predictability of traditional investments. By understanding the inherent risks of dependency on market sentiment, investors can make more informed decisions and avoid the pitfalls of speculative assets. This perspective encourages a more grounded and secure approach to investing, prioritizing assets that offer tangible value and consistent returns over time. Warren Buffett's insights highlight the risks and uncertainties of investing in Bitcoin, from its lack of tangible value and cash flow to its speculative nature and dependency on future buyers. Understanding these points can help you make more informed and safer investment decisions. If you found this analysis helpful, please like this video, subscribe to our channel for more investment advice, and leave your thoughts or questions in the comments below. Let's continue exploring smart investment strategies together. Investment strategies.